Welcome to The Explainer. Today, we're going to tell the story of a company's biggest investments. Things like buildings, machinery, and entire fleets of vehicles. We're going to follow their journey from the day they're bought to the day they're sold, all through the lens of accounting.
It seems like a pretty simple question, right? But the answer? It's surprisingly complex. See, an asset's value isn't just some fixed number. It changes over its lifetime. And how a company tracks and reports that change is absolutely crucial for understanding its true financial health.
So, to really get to the bottom of this, we're going to follow the life of an asset through 5 key stages. We'll start with what an asset even is, then we'll track its birth and its working life, look at a couple of interesting plot twists, and wrap up with its final chapter. Okay, let's dive right in. The official, kind of formal term for these big, physical, long-lasting items is property, plant, and equipment, or just PPE for short. The accounting standard IAS 16 basically defines them as the tangible workhorses of a company, things they plan to use for more than a year. Think of this flowchart as our roadmap for this entire explainer. It gives us a fantastic bird's eye view of the whole life cycle and all the different accounting paths an asset can take, from how it's measured at the start all the way to its eventual disposal. Every story has a beginning, and for an asset, that's the day it's acquired. But figuring out its true starting cost, well, it's more than just looking at the price tag. So what actually gets included in its initial cost? The core rule here is pretty logical, actually. An asset's initial cost includes everything necessary to get it into working condition for how you intend to use it. So you start with the purchase price, obviously. Then you add things like delivery, installation, even the estimated future cost of taking it apart. But, and this is key, you exclude costs of simply starting to use it, like staff training. And that distinction, it really matters, because it stops companies from inflating their asset values with what are really just day-to-day operational expenses. All right, let's move on to the next phase. Once an asset is up and running, its story is far from over. Its value starts to change. And this is where companies have to make a really big choice about how they're going to track that change, year after year. First, let's talk about the most common change, depreciation. I know, it's a bit of a gloomy word, but in accounting, it's just the methodical process of spreading an asset's cost over its useful life. It's how we account for the fact that assets wear out, get used up, or just become less effective over time. And companies get to choose how they do this. The straight line method is the simplest. Same amount gets charged each year. Producing balance hits the books harder in the early years, which makes sense for things like vehicles that lose value fast. And machine hours bases the cost on actual usage. This choice directly impacts a company's reported profit, so knowing which method they use tells you something about how they see that asset contributing to their bottom line. And hey, it's important to remember these estimates aren't set in stone. This example shows exactly that. The company originally thought this asset would last 4 years, but partway through, they took another look and decided, you know what, this will probably last for a total of 6. And you can see right here how they calculate the new lower annual depreciation charge based on its current value and its new remaining life. It's flexible. Now, depreciation is just one part of the story. After an asset is first recorded, a company has to choose one of 2 fundamental paths for how it will report that asset's value on its books from that point forward. And those 2 options are the cost model and the revaluation model. The cost model is simple. It's reliable. You just take the original cost and subtract all the depreciation you've charged so far. The revaluation model, on the other hand, is way more dynamic. The asset gets periodically updated to its current market value. So why choose? Well, a company with factories full of specialized machinery might just stick with the cost model for consistency. But a company that owns a lot of prime real estate, they might use the revaluation model to show the true, and likely higher, value of those assets on their balance sheet. It gives investors a much more current picture of what the company is actually worth. So let's see how that revaluation actually works. In this example, we've got a building that's on the books for about $1 million, but it gets revalued upwards to $1.4 million. Now, that gain doesn't just go straight to the company's profit for the year. No. Instead, it's recorded in a special part of equity called the revaluation surplus.
Of course, an asset's life isn't always a straight line from purchase to disposal. Life's not that simple, right? Sometimes there are complications, or as we're calling them, plot twists. Let's look at 2 really common ones: getting a helping hand from the government and borrowing money to build. First up, government grants. As defined by IAS 20, this is basically when a government gives a company resources, often money, to encourage it to do something, like buy a new green energy asset or create jobs in a certain area. And as you can probably guess, this free money comes with its own special accounting rules.
So, here's the crucial point. A company gets a choice. It can either use the grant to reduce the asset's cost right away, which means lower depreciation charges each year, or it can treat that grant as deferred income and recognize it as profit bit by bit over the asset's life. This choice really impacts how and when that benefit hits the income statement, which can affect profitability ratios for years to come.
The second plot twist happens when a company has to borrow a ton of money to construct a major asset itself. Think about building a brand new factory that's going to take years to complete. The interest on that loan, that's what we call a borrowing cost.
Now, you'd probably think that interest is just an expense you record as you pay it. But the accounting rules say that if the loan is for a qualifying asset, one that takes a substantial time to get ready, you can actually add the interest costs directly to the cost of the asset itself. This process is called capitalization. And the so what here is huge. It means the company reports a higher profit during the construction period than if it had expensed that interest because the cost is being added to the balance sheet instead of hitting the income statement. Well, all good things must come to an end. Eventually, every asset reaches the end of its useful life with the company. It might be sold for a nice profit, or it might just be scrapped for parts. Either way, it's time for the final chapter in its accounting story. Closing the books on an asset really boils down to two key steps. First, you calculate the profit or loss on the disposal. Pretty simple. You just compare what you got for it with its final value on your books. Second, if you were using that revaluation model we talked about, you need to clear out that special revaluation surplus that was built up. This just tidies everything up, neatly closing the story of that specific asset in the company's accounts. And here we are, right back at our map. This diagram really recaps the entire life story we've just followed. You can see how all these pieces fit together. That initial measurement, the journey through its working life, with all those choices about depreciation and revaluation, and then that final stop at disposal. Which brings us to a really fascinating final thought. We've seen that these accounting rules provide a solid structure, for sure, but they also allow for a lot of significant choices and estimates. Which depreciation method to use, whether to revalue, how long an asset will really be useful. It's a powerful reminder that financial statements are telling a story, and it's always worth understanding exactly how that story is being told.